Hey everyone, this is Dimitri Pergamonic with MarketChameleon.com. In this video, we're going to go over a ratio call spread. We'll talk about what is the objective of the strategy, how do you set it up, and what are the risks and rewards. And let's use SPY in our example. We're going to set up this strategy right from the options chain. And before we go ahead and set up the strategy, it's important to understand that you do need to have an outlook on the stock because that will be important for the legs that you choose. So let's create a certain outlook, and then we're going to go ahead and set up the strategy. And let's assume that we believe the stock price will not move that much from now to its expiration. At this time, SPY is around 430, and let's say we think it's going to be around here or drift lower a little bit from here. Given that outlook, we would want to sell a call because if the stock just sits here, we'll collect that premium. And let's pick a strike that's a little bit above the spot price. I'm going to go up 1%. Which in our case, let's say it's the 435 strike. I'm going to click on the bid of that call. And when we do that, you see a ticket come up selling the November 435 call for $6.71. Now, let's say our view is if the stock does go up, in our opinion, the move will be violent to the upside. Let's assume that we believe it'll be at least 10% or more. Well, given that scenario, we want to stop ourselves out, first of all. So let's go up from this 435 strike that we sold, and let's go up 5%. We want to stop ourselves out before it gets to that 10%. So I'm going to go up 5%, which is the 452 strike, and we're going to buy that call. And by buying that call, we stop ourselves out at the 452 strike. However, if we are convinced or we strongly believe that to the upside, it's going to be at least 10% or higher, what we want to do is buy one additional call, right? And that's why this is going to be a ratio spread. So on this November 452 call, instead of one, we're going to buy two. So now this is a ratio, selling one of the 435 call and buying two of the 452 call, a 1-by-2 ratio call spread. And let's calculate this and look at the payout diagram, what this would look like at expiration. And as you can see here, that this initial spread we collect $4.75, right? Because we sell this call for $6.71. We buy two of these for 98 cents. So you can see here we get a $4.75 credit. Now, if the stock just sits here, right here, this is the stock right now around 430, this line. Well, if it sits here, both of these options will expire worthless, right? Because they're both out of the money. And you get to keep this credit, $4.75. And as you can see here, anywhere it goes down from there, it's the same situation. Both those calls are out of the money. They expire worthless. You keep that credit. If the stock happens to go up and it drifts slowly to our long strike, that's the worst case scenario, right? Because that option that we sold will be in the money at all the way up to 450. We do stop ourselves out. And then if it doesn't go above 450, that extra call that we bought will be worthless. However, if we are correct and the stock does explode to the upside, right, all of a sudden that extra call that we bought kicks in. And let's expand this. This is 5% around. Let's expand this to 10% around. And as you could see here, once that second call that we bought kicks in, that will become profitable and 1-for-1 with the stock as it's going higher and higher once it passes your break even. So as you can see here, two ways that this could profit: if the stock just sits here, drifts lower, or if the stock has a very explosive move to the upside. Hope you guys like this video and hope to see you guys next time. Bye.